Hey everyone, welcome back to the channel. I'm Doug, the retirement guy with all your monthly ETFs. And today we're doing a breakdown that a lot of viewers have asked about. And we're comparing four of the most well-known monthly income ETFs on the NASDAQ 100. That's QYLD, QYLG, QQQI, and IQQQ. All four pay monthly income. All four use options, but they work very differently. And the difference will explain why their payouts and their long-term behavior don't all look the same. So let's get into today's video. And before I do, I got to do a shout out to all of our Patreon supporters and all of our YouTube members. Guys, thank you so much for sponsoring and supporting this channel. And if you're not part of the subscription, if you're not part of being a subscriber to our channel, why not join the fun? Hit that subscribe button, hit that bell notification. And if you can go ahead and support the channel, we'd appreciate it. Let's get into today's video. This is for educational video only, not a financial advice. This is not a prediction or future performance. We're simply walking through how each fund is structured and how those structures have behaved based on the available data at the time of the video. Past performance does not guarantee future results. If you need financial advice, always contact a financial advisor. So let's meet the contenders for today. Let's set the stage. Here are today's contenders, which is QYLD, the Global X NASDAQ 100 Covered Call ETF. They use a data-driven call option strategy with 100% covered call at the money options. QYLG from Global X is the NASDAQ 100 Covered Call and Growth ETF. This is a hybrid, 50% covered call and 50% untapped for growth. It's a balanced income and growth approach. Then we have QQQI, which is the NEOS NASDAQ 100 High Income ETF. This one's going to give you a rule-based premium income strategy. They use out-of-the-money option positions. And then IQQQ from ProShares, the NASDAQ 100 High Income ETF variant. Similar premium strategy with differences. The volatility adjusted premium approach and the balance between income and participation. So the strategy's difference. How much upside they give up and how much income are they aiming to gain? That's the teeter-totter effect. Are we going to get growth or are we looking for income? And many different viewers, many different people investing have the same thing. Am I looking for income or am I looking for growth? The covered call strategies of QYLD gives you that 100% covered call at the money. And QYLG gives you that 50% covered call with 50% growth side of it. So those are on we call our income side. Now the premium income strategies, the QQQI, is that rule-based premium income, and the IQQQ similar with different mechanics. They work with the out-of-money position. So we actually put them more on our growth side. Not saying they won't pay an income, but they also will have on the growth side of the two. So let's walk you through one by one now. We're going to start off with QYLD. This is what we call the income maximizer. The QYLD is a straightforward of the group. It writes covered calls on 100% of the NASDAQ 100 portfolio, typically at the money setting. That means the fund sells away nearly all upside potential in exchange for income. The monthly income tends to be higher, but the NAV tends to behave more flat over time because there's limited growth capture. The strategy is built for income first and growth second. When we take a look at a dive deeper into the metrics of it all, you can see this one has $8.01 billion of net assets. Their expense ratio is only 0.61%. They have over 456 million shares outstanding. Their dividend yield of 12.55%. Now, the negative to this is, we take a look at the chart, it's down 3.70% year to date. And we see the drop-offs of the April 2nd tariffs, which was a major drop-off. And then we've had the November correction, which it rolled completely out of very well. But it's still down 3.7% for a total return of 8.85% total if you held it for so far for the entire year. You look down below, the dividends have been very consistent across the board with a consistent payoffs potential. Now let's go to QYLG. Now this one, remember, is that 50-50 covered call and 50% growth. Now QYLD takes that hybrid approach. It writes calls on 50% of the NASDAQ portfolio and leaves the other 50% left uncovered, allowing for that potential upside growth. So that really means that it's going to be a lower income than QYLD. It's going to give you more growth participation, a more balanced return profile, and NAV trends that depends on how the underlying QQQ performs over time. This is essentially a middle ground for investors who want both income and growth exposure. Now, when we take a look at this one, a little smaller assets, $129 million in assets. This one's been out for a little over 5 years. But here's the thing that got me is I looked at the dividend yield is up to 24%. Now that number is going to be a little off. I just got to be upfront with people. It is a true number, but I'll explain it to you here with the dividends. Look at what this thing does pretty much every December. In 2021, it paid off over $1.60 in dividends. Went back to its normal distributions across the board. Didn't do anything in 22. Didn't do anything in 23, but look what it did in December of 24. It paid almost over $5 per share. That will change the percentage and the yield dramatically. Now, why do they do that? When we asked and looked deeper into it, it's basically what they call a clearinghouse. They clear out the one big payment once a year of just catch up on everything that they've done throughout the year. Does it happen every year? No. It's just one of those special bonus payouts which change the numbers. But now look at the growth side of this, 7.50%. So this year alone, you would have a 31.50% dividend total return. Now let's get into QQQI. Now, moving into ProShares, their high income strategy with QQQI, ProShares does not use a simple 100% covered call structure. Instead, the fund uses an out-of-the-money positions. It's a blend of option income and exposure to the NASDAQ 100. It's a systematic rules-based premium strategy. QQQI is built for income generation, but it also seeks to preserve some upside exposure depending on market conditions. The mechanics are more complex than a straightforward cover call model. So you see that the QYLD and the QYLG have a straightforward cover call model. Well, QQQI does not cover that. They use that blended option income. They use the systematic rule-based scenario, basically basing on market conditions. Now let's take a look at QQQI's metrics. The ProShares High Income Strategy has $6.76 billion under assets. Expense ratio at 0.68%. They have 123 million shares outstanding. Now, when we take a look at their dividend yield, they're at 13.46%. This fund came out January 30th of 2024. So realistically, we're almost into a 2-year window on the fund. When we take a look at the chart, you'll see the April 2nd drop off. You'll see the November market change. And then it's come out of both of those fairly strong with a 5.31% year to date growth. Now, you know, these numbers can always change. They're snapshot at the time of making the video. So you have a total return of 18.77%. So when you take a look at that, you look at the dividends. Dividends pretty much run in track with what we've seen the product does. So when they're doing that market analysis, that's what they're talking about. If the market, you see the market going up, these guys are aggressively going after that. When you have a correction, it's going to correct and continue to come back. Now let's jump into IQQ. Now, IQQ is another monthly income ETF from ProShare. And while it shares similarities to QQQI, there are differences in strike selection, contract use, and how much premium is targeted. The monthly distributions, a premium strategy is adjusted based on volatility. That's the difference. Versus market, it's versus volatility. It's a balance between income and participation. While QQQI and IQQ are often compared, the execution inside the portfolio isn't identical and their performance profiles may differ in different market environments. So the big difference is if you have a lot of volatility, IQQQ is adjusting to that volatility. QQQI, using that rule-based program and market conditions, doesn't react to that volatility. Let's take a look at the numbers between the two. $327 million in assets, 0.55% expense ratio. They have 7.15 million shares outstanding. Now their distribution yield came in at 10.31%. This fund came out on March 18th of 2024. So we see all the same things that every fund shows. An April 2nd drop off, the November correction, the growth after November. So you see a 5.99% year-to-date growth for a total return of 16.30% total return. You can see how QQQI and IQQQ are very similar to each other with different responses, primarily in the yield sector. Growths are similar to each other, but it's the yield that makes the difference. So when we take a look at the strategies, laid them out on in paper right in front of you, you can see QYLD as the worst one for the growth because they're trying to get the most total yield. QYLG gave you that good growth side of it, which is that 50-50 hybrid package. And this year so far has given a 24% yield to give us the total largest return of 31.50%. Now QQQI at that 5.31% growth with a 13.46% yield at a total return of 18.77. Its cohort, its comparable one, IQQQ, 5.99%, a little bit more growth, but you lose it in the yield at 10.31 compared to that 13.46, which basically gives it a 16.30%. So right off the bat, you see we have three very, very strong funds to work with that give you growth, yield for total returns. So when we look at the strategies and the comparisons, again, QYLD, that 100% covered, is for high income, very low growth. We see that on the boards. QYLG, that 50-50 balance hybrid, is the minimum of the road across the board. And you see that other than that yield of that 1 December payout. And then QQQI, the rule-based, out-of-the-money options, and IQQQ, the volatility-based in the premiums, you see both of those working almost hand in hand with each other, other than a little higher income from QQQI. Understanding the distribution behaviors. All four of these ETFs pay monthly, but their distribution levels can vary from month to month. Covered call ETFs like QYLD and QYLG are tied to market volatility, option premiums, and strike selections. And premium income strategies like QQQI, IQQQ can behave differently based on how their rule engines selects the strikes. An important reminder, distributions are not guaranteed, and they can change at any time. The numbers shown today are just basically a reflection of past behaviors and not predictions. So it's a snapshot of what we have. Now, matching the right strategy to the right investor style. And this is just, again, this is nothing, I'm not giving you any insight. I'm not telling you what to do or how to do it. It's just basically first time investors, they always lead to that QYLD because they want that income side of things. Personally, I'm a balanced investor. I like the QYLG. I like that hybrid system, like the growth and the income goals. If you're looking for all income, QQQI and IQQQ are probably the better avenue to evaluate and to look at. So there's a lot of key factors that you have to add into all this. Is like your time horizon. How long can you do you want to stay invested into it? What's your risk tolerances? What's your income needs? I'm not here to pick winners and losers. I'm not here to tell you which way to go. It give you advice. It's all about understanding the differences for you to make an educated decision about your investments. Because we look at the performance comparisons overview. You look at the market, and I love the chart that we put together here. You look at the NASDAQ 100 and the dotted green line, and you look how every other fund has been designed around it. And that QYLG is closer to the line than anyone else. While QQQI and IQQQ are giving you that potential growth with that income side of it. And then the low volatility environment. If we have the low volatility, then you're going to see a difference coming around where again, income investors, the QQI and the IQQQ outperform. So the key insights to remember is the strategy differences matter. Each one is built for a particular reason and built for different investors. The premium versus covered call income strategies. Now, of course, income is not guaranteed, but the monthly income can change based on market conditions. The portfolio overwriting percentage. The percentage of the portfolio that's overwritten dramatically affects the income versus growth potentials. NAV behavior, that's influenced by the up and the upside in a given way for the income. And the strategy understanding is key. You have to understand the strategy before you invest in anything, especially with these type of funds. Understand the strategy because it means you're going to head in a different direction. Investment decisions should always be based on individual circumstances. Now the risk considerations. Yes, you have to talk about risk because risk is part of every investment. Market environment risk. High volatility, premium strategies may underperform during market stress. Interest rate changes impact option premiums and evaluations. Time and cost opportunities. Time decay. Options lose value as they approach their expiration date, and opportunities cost foregone gains in the cap upsides. Strategy risks. You have to understand the strategies of that 100% covered call or that premium strategies because they operate differently. And income and NAV considerations. Distributions can vary from month to month, so you're not going to be a set it, forget it, and know you're getting 15 cents. You have different income volatility. So final thoughts, guys, these ETFs track the same index, but all are very different option strategies. And with that, you get totally different results. So the premium income ETFs have definitely have a class are different from the classic covered calls. And then you have the whole mixture of the 50/50s, the rules base and different things to it. QYLG, that's a 50/50 base program, outperformed them all with the numbers that we used. But is that right for your portfolio? So the recommendations I use ETF Analyst Guide. Go out there and find as much information as you can about the ETFs. Do your analysis. Use the ETF calculator. Tools are modeled different ETF strategies under various market scenarios. Use your resources that are out there. Overall, I always ask this. You guys tell me, what do you think? Which one of those 4 funds is the best one you think for you personally and for the market conditions as we have today? Let me know in your comments, what do you think about this 4-person comparison? I'd love to hear if you guys like the format or not. Hopefully you like it and we can continue on.
Thank you for watching. Press the like button, hit the subscribe button, and join. Leave any comments